Shibani Sircar Kurian is Head of Equity Research and Fund Manager at Kotak Mahindra AMC. Shibani, good to have you here. Prashant this side. So just your feedback, Shibani. I mean, I think that's all we can do after your, what's the feedback from your team? You have analysts, you have other fund managers. I'm sure you sort of put heads together to figure out how this is really going to play out. And what's the distilled view which is coming out from the Kotak house, Shibani?
Hi, Prashant, and good afternoon. So I think one clear view that is coming out is that uncertainty is possibly here to stay at this point in time. So it's very difficult to take a very clear-cut, idea or thought in terms of what pans out over the medium term or the near term, given the kind of situation that is ever evolving on a day-to-day basis. So in this sort of a context, there are a few key things to look at. One, when you look at markets and the way the global economy and growth is panning out, given the situation today and assuming that all things remain the way it is as of now, there is likely to be some impact on US GDP growth, and that has a second order impact on global demand. And India, to that extent, is not immune from an overall perspective. While there is a lot of thought that tariffs in India are lower than some of its other Asian counterparts, but again, we'll have to wait and see how bilateral discussions move between countries and what you were earlier also discussing in terms of what countries do on the currency front. So I think the best way to approach the market as of now is to essentially look at stocks bottom up. Look at companies which are more domestically oriented, sectors which derive demand from the domestic economy, including discretionary mass consumption, some of the banks, power, cement as segments, or even healthcare, which is essentially hospitals and domestic formulations business. We've always had the view for a while that from a valuation perspective, it is better to be in large caps as compared to mid and small caps, and that thought continues to be the case. But overall, I think we are looking at companies more bottom-up in nature, trying to look at companies where there is some visibility of earnings and where valuations are reasonable.
Okay. Shibani, hi, great to have you on. So let's just talk about whether overall there's a shift in, the house view in terms of preferred sectors. You've always had a bias for, of course, the capex side of the market, cement, of course, early investors in PSUs as well. But given the shifting nature of the market, is there a change? Is there a churn that you've undertaken at Kotak, and what would the top bets be now?
So obviously with markets evolving and the situation evolving, there is some amount of change that takes place in terms of thought process as well. While structurally we continue to like the entire capex manufacturing theme, we have also been cognizant of valuations in the past. And therefore, that is one segment where we've, if you look at our disclosed portfolios, we would have reduced weight. Some of the sectors incrementally where we've, looked at positively, one has been the entire private sector banking pack, especially the large banks and some of the large public sector banks. Of course, the sector is not out of the doldrums as far as earnings, margins, lower loan growth is concerned. But our belief is that a lot of it is factored in terms of valuations. And therefore, that is one segment which we believe remains relatively insulated in this current environment. The second area has been discretionary consumption, especially mass discretionary consumption, areas like travel, tourism, retail, QSR, for instance, some parts of consumer durables, which essentially benefits because of the tax changes that have been announced in the budget, and also because of interest rates coming down. So that's another segment that we've been positive on. Cement, we continue to remain positive on. We believe that volume growth has started to recover with some amount of government capex and spending coming back on track. And margins should hold up, given that there is lower cost pressures. And the overall thesis on cement of consolidation and market share shift continues to be the way forward. So these are some of the segments that we continue to like. And within the healthcare space, finally, I think hospitals has been a segment where we've believed that profitability improvement is continuing, though in pockets we are also cognizant of valuations, but overall within the healthcare space, hospitals is something that we continue to prefer.
Okay, hi Shibani, good afternoon and good to see you in. Well, one of the sectors of the day is actually the OMCs. In spite of that excise duty hike, which the government will be pocketing the 2 rupees, their gross marketing margins are still much higher than what we have seen in the last few years or what the street is working with for the next few years. And the kicker has come in because their LPG losses will come down as well. I see you'll have HPCL, among the listed companies, IOC, BPCL and HPCL. HPCL, it's part of your portfolio. You believe there's more to go from here, given that crude oil prices have come down drastically, valuations are fairly stable, and there is some room for the government, even if they hike duties, still there's room for them to make good money.
So absolutely, Nigel. And if you look at what's happening globally, one of the possible impacts is that oil prices, given that there is global GDP growth slowdown in the offing, assuming things stay the way they are, oil prices are likely to remain fairly muted and possibly in a range. In that sort of an environment, clearly some of the energy names and the OMCs benefit. As you rightly pointed out, these are companies which are trading at extremely attractive valuations. From a marketing margin perspective, margins are such that they will possibly offset the weakness that you will see on the refining front, as well as some of the inventory losses that you will also possibly see during the quarter. You are right that even with the announced excise duty hikes, the marketing margins at this point in time, where oil prices are, they are enough to offset the impact as well as provide better profitability in the near term. So yes, we do believe that this is one segment, given the way the global growth outlook and demand scenario is playing out, as well as way supply demand is panning out where oil is concerned. This is a segment which looks attractive from a relative valuation perspective.
Okay, all right. Looking more inward then, what about the discretionary consumption names? You've got a couple of those in there as well. And I mean, there's unlikely to be much impact of what Mr. Trump is going to say, at least no direct impact. You'll continue to bet on that?
Yes, Nigel. I think overall our portfolio strategy, as we were discussing earlier, is to look at pockets within the market which are more domestic facing, which derive demand from domestic sources. And within that, the discretionary consumption pack clearly fits the bill. What we believe is that the impact that you're seeing, or the positive impact, I might say, of the tax cuts is starting to flow through now, especially where the middle income segment is concerned, and that should play out as far as some of the mass segments are concerned. Now, overall, within the discretionary pack also, we are looking at companies where valuations are reasonable, where there is some amount of certainty or at least visibility on earnings. And therefore, segments such as, for example, travel, airlines, tourism, parts of retail, which is more mass in nature, parts of consumer durables, two-wheelers, for instance, which also derive benefit from the rural segment. These are names that we are looking at across the portfolios.
Okay, all right, got it. So to sum it up then, Shibani, what's the sense, what's the advice? It's anyone's guess as to when global markets stabilize, but over the next, say, quarter or two, are you expecting, I mean, is consolidation the best case scenario, or do you see the bull charge resuming anytime soon?
No, I think that at least we'll have to muddle through volatility and uncertainty in the near term till you start getting a sense in terms of how countries are, carrying out their discussions with the US and what's the final outcome. So near term, Surabhi, I think uncertainty stays. The best thing to do in this sort of an environment, even though while the medium term outlook on India seems to be fairly okay at the margin with, liquidity, as you were also discussing, improving GDP growth appearing to bottom out for India, as well as rural demand picking up. But I think in the near term, it is better to, one, stick with large caps over mid and small caps. Within the mid and small cap space, go extremely bottom up, be very stock selective, stay away from pockets of high valuation, look at companies where there is some degree of visibility on earnings and where valuations are reasonable. So I think that's how we are really approaching the market at this point in time. One thing is for sure that, we'll hear a lot more on tariffs. This is clearly not the end. So possibly over the next couple of weeks, months, there will be a lot of evolving parts and moving parts which will shape our markets going forward, as well as global markets.
Yeah.
All right, Shibani, we'll leave it there. A good conversation as always. Thanks very much for your time. Appreciate it. Well, the market has come off a little bit, 120, 130 points off the highs, basically from the 230 levels, and we're above 22,500 at this point in time. We'll take a quick commercial break here. As always, we get you what's happening in dealing rooms. D-Street Chatter with Nimesh comes up, and of course, some trading ideas with our technical experts as well. Stay tuned.